Everything you hear today is general advice only and has not taken your personal circumstances into account. If you are considering making an investment, you should speak to a financial advisor.
Look, the backdrop for those returns has been an extended period of underperformance of small cap stocks. This chart is going back 5 years, and you can see that small cap stocks have underperformed their larger counterparts by a very significant margin. And that did not reverse in 2023. It was a year where the outperformance of large caps was not as significant as it had been, but there was certainly no catch up in terms of performance.
Smaller cap stocks, which is a mainstay of our portfolio and is not an important part of the index which we follow, have had a very difficult few years. But we absolutely want that exposure most of the time, and particularly at the moment. In our June quarterly report, we likened the current situation in small caps to a coiled spring, ready to bounce at the first sign that bad news abates. Owning lots of small cap businesses isn't a bet that paid off in a relative sense in 2023. It was a continued mild headwind. We've almost kept up with the index regardless, so we're very happy about that situation. We think our concentration into smaller cap investments will pay off handsomely sometime over the next 3 to 5 years. On the right-hand side of the chart, you can see there the distribution by market cap size. Just important to note, 2/3 of the fund currently invested in businesses less than 10 billion and more than 1/3 in businesses less than $2 billion US market cap. So higher exposure to small caps. That's fairly normal, but it is something to be aware of as an investor.
So we want to leave you with two really key important slides about what the setup here actually is. We mentioned that 2/3 of our portfolio is exposed to companies with less than 10 billion market cap in size. Well, why do we like the setup for these kind of companies at this point in time? They have a history of long-term outperformance versus the broader market. On this chart here, you can see the Russell and the S&P small cap index versus the S&P 500, i.e. the large caps, over a period of 23 years or so. Long history of outperformance. They tend to grow faster, they're smaller businesses, and they're more mature counterparts. Often growth slows as you enter that phase. So other more important part here is that they tend to do very well from early on in recessionary periods. We've looked at the last kind of 5 recessions and there's studies on this, but they actually start to bounce as you enter into a recession. Now, the current market exposure, this is in the US in particular, to small caps is extremely small. We're talking about 5% of the market cap being small caps at the moment, which is right near the COVID-19 lows. That presents a really exciting opportunity. M&A is another important tailwind for these kind of businesses. They're obviously smaller, so larger companies tend to gobble them up if there's value to be had there and if they're trading at too cheap levels. But doing M&A as a smaller company also tends to move the dial more than for your average mega cap or large cap. Now, these companies are generally under-researched and under-covered by brokers and other investors to some extent. You have an average of 3 brokers covering a company of this size relative to 15 covering larger caps. Now, this final chart here actually illustrates how severe this discount has become, particularly over the last 2 years. Small caps tended to trade at a premium, or at least in line with the S&P 500 over the past 20 years. But what's happened more recently, since 2021, is a humongous relative derating. They're now sitting at a 25% discount, as you can see on the chart on this page. Now, the past year has shown us some signs of stabilization. We actually firmly believe that the worst is largely behind us in terms of this derating. But there's a lot of pent-up upside in many of these companies and many of these valuations at the moment relative to the broader market. And this is why 2/3 of our portfolio is currently invested in companies less than 10 billion in size. So we hope it's going to be a good couple of years ahead of us. We feel confident that we're in some very strong and quality businesses as well.
It has been even more significant here in Australia than it has been globally. In fact, if you look at this chart going back 5 years, the small cap index here in Australia is hardly up over that 5-year period, where you've got the large cap index up almost 50% over the same period. So there's been dramatic underperformance, and we've had a pretty good year. And that leaves us in a really good place to be able to keep recycling capital into new opportunities and into a market that is still offering significant amounts of value at the small cap end of the market.
And on opportunities for the 2024 year, one of the areas we're looking at intently is beaten down smaller and micro cap stocks. Now, over the last 3 years, we've seen a 28% cumulative underperformance of smaller industrial stocks to the overall larger cap indices. Now, there have been many reasons for this. Attention's dissipated from the space, money has flown out of funds, and liquidity has worsened from already low levels. This is a vicious cycle. And it's left some of these smaller businesses trading at particularly attractive valuations.
So maybe some sectors are worth calling out and for you to keep in mind that we talked about consumer discretionary stocks earlier. To give you some context, the basket of 10 discretionary retailers that we showed you before have declined around 50% in terms of share prices over the last couple of years, and that corresponds to a 15 to 20% earnings cuts, and the balance 30-35% corresponds to multiple compression, and hopefully that set up for some interesting opportunities in this coming year. The other one worth calling out is non-bank financials. Over the last couple of years of easy money, you might have seen these non-bank lenders making loans left, right, and center and booking profits based on estimates of bad debt. It's only when the tide rolls out that we get to see who's been running a viable business and who isn't. Maybe another one to call out is fund managers. We only know too well from our own experience that these businesses are highly geared to equity markets. When equity markets reset lower, there is a potential for a vicious cycle of lower inflows, lower fees, operating leverage working backwards, and maybe even negative valuations on top of that, pretty much in the same way that retailers have done. These are just some of the opportunities that we're focusing on into the new year.
We've been able to deliver strong performance throughout 2023, despite further small cap underperformance. We think the setup is really nice. We think small caps deserve a larger weighting in a lot of people's portfolios than they have at the moment. We think both funds are set well to perform over the coming 5-year period.